All right. Well, welcome everybody. Welcome, Jake. How you doing today?
Yeah, doing well. Glad we're hitting the podcast topics strong this year. So yeah, no, I'm doing well today.
Perfect. We had a
So
we had
what
a
about
few
you?
weeks off on the podcast. We're back in action, and we're going to talk about required minimum distributions, which I'm sure is on everybody's mind right now.
This is going to be the most exciting, boring topic maybe we cover.
Yeah,
So
let's get some listeners out of it. All right, so Jim Kantowski, Jake Sadler, we're here to share knowledge about different topics from a financial perspective, and we want to do it in a conversational way. So we're going to have this conversation here, and we're going to have it about requirement of distributions, as we mentioned. And we're just going to start out, Jake, and we're going to say, what is a required minimum distribution? I'm putting that on you.
yeah, so and I'm just going to point out here, required minimum distribution. This is kind of a tax topic. The IRS frequently asked questions page, really a good resource here, especially with all questions RMD related. So required minimum distribution, sometimes abbreviated as RMD. Sometimes you'll hear it referred to as a MRD or a minimum required distribution, but we tend to like RMD. Most people are familiar with that term. This is generally the minimum amount that an account holder of certain types of retirement accounts has to take out each year once they reach a certain age. And the basic idea is this for these types of retirement accounts is that we get an income tax deduction, or we don't have to include in our income the amount we contribute to these types of accounts, think 401k, IRA, as we are accumulating and growing those dollars. And the IRS says, okay, we gave you a little break, and we gave you a break along the way as you grew these assets over time. So you were able to grow them, weren't paying taxes on the growth along the way. And at a certain age, the Internal Revenue Service says, we need to start collecting some of our tax money back. We gave you a break for a nice long time. It helped to incentivize you to save over the years. We want some of our tax money. You have to take this amount out each year once you reach a certain age. And that's kind of the idea.
So a required minimum distribution, and we'll get into like ages and that sort of thing, but it's an amount that you have to take out of a retirement account once you hit a specific age, essentially for the rest of your life. And we'll talk about rules if you pass away and that sort of thing. But and there's no free lunch. I think I heard you say essentially is you get this tax deduction up front, and then the IRS essentially will ask for some of the tax back in the future.
That's right. And so I think in a lot of cases, the RMDs they kind of are held out to be kind of like the boogeyman of tax planning in retirement. We've got these RMDs coming up, and it seems kind of ominous. With careful proactive planning, RMDs just fit really nicely in almost every case to folks' retirement planning and income planning. So I just want to kind of dispel that right away. I mean, it's not the end of the world to have our RMDs. They're required. It's in the name. So we got to take it. And we got that tax break along the way and up front.
So you mentioned accounts. What type of accounts do we need to think about when we're thinking about RMDs?
Yeah, when we think about RMDs, we are thinking about traditional IRAs, so pre-tax IRAs, which could also be a rollover IRA. So if you had an old workplace retirement plan that you rolled over into an IRA, and it's a rollover IRA that would have the RMD requirement as well. So traditional IRAs, pre-tax IRAs, 401k plans, 403b plans, 457b plans, SEP IRAs, simple IRAs. So you can essentially break it down into those two categories, IRAs and employer-based retirement plans.
Right. So a lot of IRAs, there's also, that would include Roth IRAs.
Yeah, so the Roth IRAs, and this is where the whole topic of RMDs, it kind of gets pretty complicated pretty quickly with a whole lot of rules. So Roth IRAs do not have an RMD. So no required minimum distribution for Roth IRAs. And now, effective this year, no required minimum distributions for Roth 401k or Roth 403b. So if you have a Roth account within your workplace plan, those no longer have a required minimum distribution either. They used to, no longer. So if we think we can break it down simply, pre-tax, traditional IRA or 401k has the RMD, anything Roth.
All right, so perfect. So you got a tax deduction for it up front. You need to pay the tax later. With a Roth IRA, you don't get that tax deduction up front. You've already paid tax on it, so the IRS isn't maybe is concerned about getting that money back. So, so let's start with the IRA, and I guess that applies. Well, we got to be careful because the 401k and there's maybe some different rules with some of these things. So let's just simply start with the IRA. And the IRAs have had some recent changes over the years. So maybe just a little history on what the required minimum distribution age was and where it is now.
Yeah, that's because it's changed quite a bit over the years. And interestingly, someone took the time to post on the internet a really interesting blog post on the history of RMDs. I was cruising through that a little while ago, and so the RMD has been around since 1986, and originally the RMD age, and for a long time, was 70 and a half. That has changed. And so I'll give you kind of the snapshot of where we are. Some folks started at 72, but now the new rules, if you were born between 1951 and 1959, your RMD age is 73. And if you were born 1960 or later, your RMD age is now 75. So that has changed a good bit. But there are still some things, related to age 70 and a half, but that is no longer the RMD age.
So, all right, let's think about this. So if you were 72 last year, you were already in the RMD process. It's my understanding that if you turn 72 in 2023, you have until your RMDs don't start until 2024, right?
That's correct. Yeah, if you're turning 72 this year, this is 2023. If you're turning 72 this year, last year you thought you were going to have your RMD in 2023. That's changed. You no longer have your RMD this year. That can start and will start for you next year.
All right. So
the RMD amount, just to be clear, and you may have had this question, coming up later, but the RMD, that's the minimum amount that needs to come out from these types of accounts in each year. And you can take that amount all at once. You can take it at the beginning of the year, middle of the year, end of the year. It doesn't matter. You just have to take that amount out. And then that amount is counted as taxable income in the year that you take it out. That's the whole idea. Now, in your very first year for RMDs, there's a special rule. It gets a bit more complicated. I know, yeah. So you can actually defer your first RMD to April 1st of the following year, but there's a catch. It's not a free lunch. You have to take two RMDs. You have to take your first year RMD and then the second year RMD all in that subsequent year. So we don't see that strategy come up a whole lot, but it is something to point out as we're kind of going through these techniques.
Yeah, so I'm trying to keep some notes over here and try and keep it as organized. So let's go back to, we keep talking about that amount. What is that amount? Can you give us a sense of how it's calculated, what it looks like, what it's based on?
Yeah, so that's a really good question. So the amount that needs to come out, essentially as the taxpayer, you're kind of required to calculate that amount yourself. This is where, it really does come in handy to be working with a tax professional, financial planning professional who can help you to coordinate these. Nowadays, the custodian for these types of accounts, they're doing a much, much better job of proactively letting you know what your RMD amount is going to be. So a lot of times we can lean on the custodians of our accounts to calculate that amount for us and let us know. They will not automatically send you that money. So you have to make sure that that money comes out. You, the taxpayer, the account owner, has to make sure that that money comes out. The custodian will automatically do it for you. The amount is calculated based on a life expectancy table that the IRS has. They've changed it a few times over the years. It's pretty generous in terms of an actuarial life expectancy table. But basically, we use that table to kind of see what the life expectancy is at any given age, and then kind of use that as a factor to use to determine and calculate the amount.
So we come up with this factor based on this life expectancy table, and it is you divide the previous year's balance as of 12/31 by that factor to calculate your required minimum distribution. Did I get that right?
Yep, that's right. Yep, so that's right. So you can kind of do the simple math there, but one of those key inputs in that calculation is that okay, you have this table based on life expectancy. What amount are you using to calculate with? It's the closing balance on December 31st or the last market business day of the previous year. So 12/31 the previous year.
And so you don't have to take that out until December 31 of the following year. And, we get this question all the time, like, hey, when do I take it out? And there's a lot of flexibility when you take it out. Like you mentioned earlier, like monthly, quarterly, whatever you want, you can do it on December 31st. Although I would be careful with that because you don't want to miss taking these things out because
there's a penalty. No, that's a really good point. Yeah, you do not want to miss your RMD. The penalty used to be 50%. If you missed an RMD, you could potentially, be penalized by 50% of the amount of the RMD that needed to come out. So pretty hefty penalties. That's changing now. So we're going to see a decrease in the penalty amount. It's going to go to 25% and then 10%. So, but there's certain criteria if you do miss your RMD that you have to follow to make sure that you can kind of apply for that, some relief there from the penalty. But anyway, I do want to kind of really echo your comment there, Jim, that do not wait until December 30th, 31st to try to get your RMD out. If you're waiting until the end of the year, get it done at the beginning of December, middle of December at the latest. Most custodians, they are really tied up and jammed up with work at the end of the year. And sometimes they won't promise to get these types of transactions done if you initiate them after a certain date, like mid-December.
Yeah, you definitely want to start working on that earlier. I know we get really swamped in December and with labor shortages and everything that's going on in the world, that became a little bit of an issue this year. And we really were required by the custodians we work with to have that paperwork in by early December, I think it was this year, in order to make sure, guarantee that those got processed. So this is something you don't want to wait on. You want to think about it, earlier in the year. I guess technically it's probably best to leave it in as long as possible, but you're not going to earn, so much money on it that that you shouldn't think about getting it out at least in October or November or something of that nature.
And I think that brings up another really good point. And this is kind of one of those common, myths around the RMD. You have to take the money out as taxable income. You don't have to spend it. So we have a lot of folks that just reinvest they take the RMD out and then they reinvest it in a taxable account. So the money's out, they met the requirement, from the IRS for the RMD, and they don't need the money. So, reinvest it in a taxable account. So that can be a strategy if you don't actually need the money for your expenses. Maybe you have, a solid pension and Social Security that's covering most of your bills, and you just don't need your RMD from year to year, and that can certainly be the case.
Yeah. So, all right. So you actually, now I'm going to say you brought up a good point because I'm going to tie this back into, you don't have to spend the money, but you also, to use some of this money, and we're going to talk about maybe some planning techniques in order to minimize these required minimum distributions in the future. You don't actually have to wait till 72 or 73 or 75 in order to start using your IRA money. So I know you and I talk a lot about, converting money in years where your income's low and you convert it to a Roth, or, when you're thinking about your cash flow needs, once you sort of retire, you think about using some of this money in lower tax years, because the real benefit to me is you're in your working years, you're putting this money away into one of these tax deferred account. And as you mentioned earlier, you get this tax deduction. So in theory, you're working and you're in a higher tax bracket while you're earning a lot of money. And so one of the big advantages to these is if you can get a tax deduction, let's say 30%, retire, your income goes way down, and maybe take some of that money out at a 12 or 22% tax bracket. There's that spread Let's forget about the earnings that you tax deferred growth and all that stuff for a second, but there's a spread that you can take advantage of if you can take money out in a low tax year.
Yeah. Yeah. No, that's, as you know, the way that we tend to think about as planners, the RMD is it's framing what for many folks is something we call the tax planning window. So for a lot of folks, as they enter into retirement, just like you pointed out, you retire, just say kind of traditional retirement age 65. And maybe they've gone from kind of their peak earning years. Now they're in retirement and they're drawing from various variety of different resources. A lot of times we see that tax rate decrease at the onset of retirement. And maybe for some folks, they're delaying the start of Social Security until maybe age 70. And money doesn't have to start coming out of these IRAs or the workplace plan until, 72 or now 73 or 75, depending on your year of birth. And so we see this kind of valley, if you will, if you kind of think about this, timeline of tax rate over the course of your life. And it's kind of growing over time as you're, entering maybe peak earning years prior to retirement. You retire, you see that drop off in the tax rate. And we kind of want to take advantage of that to the greatest extent possible. We want to understand what that window of time is going to look like. Like I pointed out earlier, the RMD kind of frames the other end of that tax planning window. So we want to look to do certain things. Maybe we're harvesting capital gains at a low rate, or maybe, like you pointed out, in an effort to reduce future RMDs, we're taking money out of our pre-tax accounts, our IRAs, our 401ks, we're converting them to Roth IRAs, where we don't have an RMD requirement later on. So we're kind of intentionally creating income to fill up these lower tax rate buckets during this tax planning window. That's really key to a lot of good proactive planning that we're doing during that period of time.
Yeah, and if you think about it, now that this potentially this requirement of distribution age is 75, if you don't start taking your money out 75, and let's say you live to, let's say 92, for example, that's not a really long period of time to take out your money. And so if you've accumulated a lot of money in that IRA, like those withdrawals could get pretty big, and that could put you in a much higher tax bracket. Plus, I mean, this is nuanced and we can get into it. Plus, that's going to go on top of your Social Security, and maybe it's going to go on top of like capital gains and other income sources. And so if you wait a really long time, we all think that's the best strategy. But if you wait, that could create some headaches for you or some higher tax rates down the road.
This is a huge point in the new landscape for RMDs. So for folks born 1960 or later, RMD age is 75. And while on the surface, that sounds, that's great. I'll have to take my RMDs for even longer. Maybe begin scratching your head and say, okay, well, doesn't the IRS want their money sooner? Why'd they extend this out? Well, the idea, the rationale is that from a revenue perspective, from the IRS, now you have a higher distribution amount within a shorter window of time that's going to impact and kind of stack on other sources of income. And so we kind of see this tax crunch coming for folks where RMDs are starting 75. And so you're taking more out from those accounts over a shorter window of time. And really importantly, I think here's maybe a segue into the RMD rules if you inherit an IRA, because this is a big one. And this goes into the rationale and logic behind increasing that RMD age. So I won't jump to that question. I don't know if Jim, you had anything else.
Yeah, it's good. It's really a good time to think about what that means. So what Jake just mentioned was you have this IRA, you pass away, there's typically a beneficiary designated on those IRAs, so it passes directly to them. We don't have to worry about too much if it goes to a surviving spouse because, they're still living and there's some special exemptions for them. But what Jake is pointing out is like, if this goes to your son or child or somebody that's not your surviving spouse or there's some other people, that money has to be taken out with a 10-year window. And so that definitely could bunch up those distributions to become significant. And if your child or whoever inherits this money is actually in their highest earning years, then that money is going to really get hit hard in terms of taxes. You could get taxed at 37%, on all that money coming out at your kid's level, and lose a lot of wealth if you don't really plan properly for these distributions.
Yes, that's an important part of this whole, the way that we're thinking about RMDs. If we think about, typical life expectancies, you're starting your RMD at 75, you're taking money out for, most likely a period of 15 to 25 years. You're probably not taking it all out. That money is flowing by beneficiary designation. Like you pointed out, maybe to a spouse, there's special rules for spouses, or to a non-spouse beneficiary. And then they, if you die after, 2020 or later, that money has to come out in almost every case within 10
Yeah.
years. And so if you think about kind of just demographically, okay, we have folks with life expectancies in the 80s, typically maybe in the 90s, and they're leaving assets, oftentimes to beneficiaries who are, say, in their 50s or 60s, and a lot of times in their peak earning years, and they have to take out all the money from an IRA that they inherit within a 10-year time frame. That's adding a lot of taxable income at what is probably already a pretty high tax rate. So we have a whole lot of it, all of this to say. I think if we kind of take anything away, any nugget away from this, there's a whole lot more incentive right now in this new landscape for RMDs to be proactive in this tax planning window prior to RMDs, to understand the impact and what opportunities there may be for you to reduce your RMD.
Yeah, really good point. And there's all kinds of different directions we can go on this. I'm going to step back for a second because we're talking about taking money out of IRAs early or before your requirement and distributions to essentially convert to a Roth or use as income. But you have to be also really careful when you do that. And this is why planning is really, really important in that valley years that you're talking about, because, let's say you started taking Social Security at age 65, right? And you have no other income sources. You might not actually pay any tax on that Social Security because, if you have no other income, your Social Security, it's this sort of gradual scale. And so if you add income, you might now be paying taxes on your Social Security, right? I got that right?
Yeah, for sure. Sometimes we call that the tax torpedo with Social Security.
So
I don't know if you've heard that.
Yeah, well, that's a really good one. So a lot of times, one of the valuable reasons to wait to take Social Security, other than it's continuing to grow and accumulate and so forth, is that it could potentially reduce your taxable income. You can get some of this money out of your IRAs really early and not create tax on your Social Security. So that's sort of one thing I wanted to point out to look out for. And I'm going to let you comment in a second. But then the other one that I've run into a couple times is if you retire a little bit early, let's say it's 60, and maybe your income's low and you're just using cash from some savings accounts or something like that, and you've needed to get health insurance on the exchange, you could get a pretty big credit and the government can help you pay for that if your income's low. So if you take an RMD or not an RMD, but you take money out of your IRA, you could potentially lose that credit because your income, you get pushed into a higher tax bracket. And then the last thing to be careful of is, I got to take a deep breath because this is all the things we think about. But we have this capital gains rate currently where if your income, this is a hard one to explain, is in the 12% tax bracket and you have capital gains, you actually pay 0% tax on those capital gains. And so once you go over that 12% tax bracket, the capital gains over that are taxed at the 15%. And so taking this money out of retirement accounts could potentially affect some other taxes you have to pay.
Yeah. I mean, all this is super important. And I think maybe if we're just to create an umbrella under which all these kind of things to watch out for fall under, it's okay, we've got this RMD coming, let's be very careful and intentional about how we're taking money out of our IRAs prior to the RMD start. And so we don't, if we are trying to avoid the RMD or kind of reduce it in some way, you can take money out of the IRAs over time before RMDs start. You really need to be really careful about how you're taking money and the amount that you're taking out from, say, an IRA, qualified plans and so forth, because it's gonna, it's gonna interact with all your other sources of taxable income. And I think just as a strategy, and something that we do see is, yes, absolutely, you can intentionally take money out of your IRA. You don't have to convert it to a Roth. You can use it for your ongoing expenses. If you're delaying Social Security, or whatever your situation is, you can absolutely, as a good strategy, just take income from your IRA at a low tax rate, and just do that. So I think that's something to point out as well.
Yeah,
We don't want to just be like overly avoidant of the RMD and then create problems, a decade.
Yeah. So the bottom line is there's just a ton of moving parts with this stuff. It's really important to start thinking about it and not waiting to think about it when you're age 75. You really want to start thinking about it, as you're approaching those retirement years. And I'll go a step further is I think what's really valuable is having money in multiple places. And what I mean by that is having money in just regular taxable accounts that you could access in cash or through capital gains or whatever, having money in Roth IRAs if possible, where you can pull money out tax-free, and then having this pre-tax money. I think it's really important to sort of spread it out a little bit as opposed to socking everything away in a pre-tax account, and then being sort of paying tax on everything. It just provides less flexibility is all I'm trying to say. So just think about, as you're saving money, where you're saving it early on could help eliminate some of these problems way down the road.
This is how I think a topic as kind of foreign to, say, younger folks as an RMD becomes relevant, because as we're thinking about accumulating, especially maybe in your younger kind of earlier earning years, I think the decision around which account type makes the most sense to fund, it's helpful to think about RMDs. Okay, here's the current year tax impact of saving in a pre-tax account or a Roth account or a taxable account. Let's fast forward a few decades just to kind of get an eye for how this is going to impact you later.
So the question I have to ask, Jake, you might have been better than I, but at 25, were you like super conscious about your RMDs potentially at 70 and a half and planning for it? I don't think I was.
I tell you what, the Roth IRA, as when we look at kind of time horizon for investors, the Roth IRA can make a whole lot of sense for a lot of investors across different ages, but for younger investors in particular. We know already under current rules, okay, we don't have the RMD issue with our Roth. Maybe we're paying more in taxes, and it's just, we could put it in a pre-tax account and get a little bit of benefit, in the current year. That's nice. But if we just kind of think a little bit, beyond that, you pay the tax up front, is tax-free forever thereafter if you follow the rules. So I think when we think young, we think Roth.
Until they change the rules. But I'm not going there. The one thing we're pushing on our time limit here, and we're exhausting those pieces. But actually, now that we're talking about it, like there's just so many factors that go into it. And one of the things we're not going to touch on in this is that with this new Secure Act 2.0 that we alluded to, some of these changes, there's some additional things going on with the Roth IRA where employers might be able to start making their share of their contributions from a Roth perspective. Catch-ups might have to go in as a Roth if you make over certain levels of income, and so forth. So there's a lot of things to think about around when you're saving and where to save it, and then how it's going to come out in the future. And that's our job to figure out.
It is, and I'll just echo kind of one last point to what you were describing. If you can enter into retirement with a tax diverse mix set of accounts, so you have your pre-tax accounts, you have your Roth accounts, you have your taxable accounts, I think that's a really, in a lot of cases, a good strategy to pursue. So this tax diversification, and you can only create that over years and years as you accumulate. And so I think it's something to be mindful of. Flexibility sometimes means doing a little bit here and a little bit there. So it's not all or nothing. And I think flexibility can go a long way.
What'd you call that? Tax diversified accounts. What, you said it in a nice way. I like that. I might have to use that.
A tax diversified mix of accounts.
Diversified mix of accounts. I like it. Tax deferred mix of accounts.
Yeah.
All right, Jake. Well, I'm glad we're back. doing these shows, and we'll put this one out next week. And as always, I haven't gotten any feedback yet, but if anybody wants to provide us feedback or topics that we want to talk about, please shoot us a message, and we'll keep knocking these things out. We'll get some listeners.
We'll get some listeners, and we talked about RMDs for 30 minutes. I feel like we could talk another 30 easily. So
it'd be difficult. All right, Jake, enjoy the rest of your day.
Yeah.